Hello everyone, welcome back to our YouTube channel, and today we are going to look at what we call the Petty Cashbook. So we are going to look at the Petty Cashbook, and this is going to be our video number 1 on Petty Cashbook. So we are going to look at the Petty Cashbook and the imprest system. We are going to look at the Petty Cashbook and the imprest system and how it works. You are going to understand how it works, the imprest system and how it works. Now, what I want you to understand right from the beginning is that there is a type of cash book that is called a Petty Cashbook. There is a type of cash book that is called a Petty Cashbook. And as the name suggests, if you look at the word pet from the dictionary, pet means, it actually means small. It means small, and what we are going to learn about is the fact that we are going to learn about a small cash book. That's what we are going to learn about. Whereby when we talk about a small cash book, we try to maintain a separate cash book which is different from the main cash book. So we try to keep a different cash book that is separate from the main cash book. Of course, the main cash book is what we already looked at. We already looked at what we call a single column cash book, a single column cash book. These are the main cash books. We also looked at the two column cash book. We also looked at the three column cash book. So those are the main cash books that we have in the business. The business has those three as the main cash book. So we are going to keep a separate cash book that is called a Petty Cashbook or a small cash book that is going to be separate from the main cash book that we may maintain in a business. Now, the other key thing that you need to understand is that a Petty Cashbook is not found in every organization, because some organizations don't maintain a Petty Cashbook, but others do maintain a Petty Cashbook, and we are going to understand why. Practically, the reason why some companies keep a Petty Cashbook and others don't is because it all depends on the volume. It all depends on the value of the cash flow, the value of the cash flows each organization has. For example, if maybe we look at a particular company, maybe we look at Chuck's Holdings Uganda Limited. Chuck's Holdings Uganda Limited. I told you this is our company. Of course, this is a company that we have just started this year. So we expect, or it is going to be assumed that as the business is just beginning, we expect the value of its cash flows to be a little bit smaller. So once the values of its cash flows, when we talk about cash flows, we are meaning what is coming in and what is going out of the business, either cash inflow or cash outflow. In terms of the value, or it would be the volume. If let's say this company, maybe its cash flows are within millions, or they are just in hundreds or in thousands. Let's say they are just in thousands of whichever amount. So you'll find that a company that is going to be in millions of its cash flows, that every amount that is maybe coming in or moving out is in millions, and maybe another organization is still having maybe 100,000, whichever thousands, maybe that is still in thousand stages. So you'll see that this company that is within millions, it will have higher values in terms of the amount that is moving in or that is coming in. So some organizations, their cash flows are going to be very huge, to the extent that some small, or what you call the pets, or small expenses, we may call them small expenses. And because I've told you that an organization that has huge sums of money in terms of what is coming in and what is going out, maybe the cash flows are within billions of US dollars, you'll find that some small expenses that are being paid within the organization, when they are recorded in the main cash book, then you'll find that those amounts are going to look immaterial. For those who did the auditing, when we talk about immaterial, you know what we are. Immaterial immaterial, or what you call insignificance. It's not a significant amount, insignificant or insignificance. For example, let's maybe try to imagine an organization that is maybe making billions of US dollars. Their transactions are in billions of dollars. They are in billions of dollars, and most of the expenses in its cash book, they are all going to be, maybe these cash flows are going to be in billions, but maybe what is reflecting in the cash books, they are all in millions of US dollars. They are in millions of dollars. Now, let's assume that that same organization wants to buy something small. Maybe they want to buy books. Let's say maybe they want to buy pens. That is part of stationery. So they want to buy pen. So, and let's assume maybe the pen is costing, maybe let's say $5. It is just $5. Now, if we want to record this transaction within the main cash book that is already in millions of dollars, you will see that these $5 will look immaterial. Immaterial means that the amount can easily be ignored, that even when it is ignored, there is no big impact. So in auditing, we look at what we call figures being material. A figure that is material, it is that figure that can change either a profit to become a loss. If, let's say, for instance, we have maybe the company has made maybe profit of the profit after tax, and maybe the profit after tax is 10 million US dollars, and you find that within the expenses that they deducted to reach at the profit after tax, they excluded a figure that is, let's say, 12 million. This 12 million will be a material figure, because if it is included, it will change this profit of 10 million into a loss of 2 million. Because remember, for us to get the profit after tax, we have to get the profit before tax. It is within that profit before tax where we have left off the expenses. Let's assume that we had skipped an expense of 10 million. So this 12 million, if included, it will change this profit of 10 million to a loss of 2 million. That figure will be material figure. But a figure is going to be immaterial if it doesn't have any impact. It doesn't have a significant impact on changing the profit or the state of the state of the company. Because I'm just looking at the profit. If let's say the figure we had skipped is, let's say, 5,000 US dollars, you'll find that even if we include this 5,000 within the profit that we had skipped, it will not have so much impact on the profitability of the business. So you'll find that this one will not change much. This 5,000 will not change much from the profitability of the business, because if you less on this one, it will be 9 million, which is still has the same positive profitability. So that's how we can know that the figure is going to be immaterial. So it is the same thing. If the missing expense was $5, but the profitability is just 10 million, this $5, even if you include it or you exclude it, the impact won't be so much to change maybe the position of the business. So that's what we call the immaterial. So these figures are too small that when they are included in the main cash book, they will look insignificant or immaterial. So these figures are not going to look material. For example, if all the figures were in millions of US dollars, but you have maybe just 50 cents or maybe 50 US dollars that was included, that figure will look immaterial. So what do we do if the company has very huge values of its cash flows? They are in millions or billions of US dollars. What we do, we make sure that we separate these transactions, these small expenses, into what we call a petty cash book. So that's why some of the companies don't keep a petty cash book, because for a company that is too small, it can incorporate, if let's say all the amounts are in thousands, and maybe their small expenses are now, let's say, 5,000 US dollars, you may find that this figure can easily be included in the main cash book, and the figures will all look material. So that's one of the reasons as to why big companies keep these petty cash books, and that's one of the reasons as why some companies don't keep the petty cash book, because if all your transactions can be included within the main cash book, without having to see that other figures are going to be too high, then you will not have any reason as why you should keep a petty cash book. Now, having understood that, we want to see when the things happen. So when such scenarios where the company is having its cash flows in billions, but it has some small expenses that it needs to take care of, because these small expenses are going to be there in the organization. So they will be recorded separately from the main cash book because their figures are too small to be included in the main cash book. So when that happens, you realize that these pet expenses or small expenses or the expenses that are of low value, when they are added up in the main cash book with huge amounts, they will make the cash book to look in some way or the other. So what you do, you try and separate these expenses so that you don't exclude them, because they are expenses that are incurred in the business and we need to record them, but only that they are too small to be included in the main cash book. So what you do, you put them in a separate, you record them separately. So you try to separate those expenses which are very small from the major expenses that you do as a business. So you are going to make payments and also receive some cash of the major cash book, but at the same time you go on to create a small cash book called the petty cash book, where you are going to record these small transactions or the petty cash expenses and incomes. So, however, what we normally do in the organization that maintains this system, so when you are maintaining that system, we call it the impressed system. Impressed system. So when you maintain that, we say that you are maintaining that impressed system. And what we basically do with that organization that has that system is that they always have what we call a petty cashier in the business. This is a position someone holds that office, and is the job for that person. It will be that person who is always in charge of those petty cash items. But what we normally do is that the petty cashier will give something that we call an imprest. It will be from the petty cashier who will give something that we call an imprest. But we are going to talk about the imprest system. We are going to talk about this imprest system a little bit later. Imprest system, and we'll try to explain it. The imprest system as well, because this is the system that is used to operate the petty cash book. Now, what the petty system or the imprest system does is that you are going to be given, this petty cashier is going to be given an amount of money. The petty cashier is going to be given an amount of money, and that initial amount of money that you are going to be given as the petty cashier is what we call the cash float. You are given, it's more like these guys who are operating the mobile money. They are given float. They always have that float that they keep sending to different people. So that the cash float is the amount that you are going to be given as the initial amount you are going to start with. It can be any amount depending on how these organizations operate, because these small expenses, they are going to be so many that you can't include them. And that's why you find that they recruit someone who is going to be managing those small expenses, because they are too small in the amount, but they need to be managed, because if you don't manage it, people are going to misuse the money. They are going to eat the funds. So what you do, you appoint someone who's going to be looking after those small expenses. And every period, maybe within a month, someone is going to be given what we call a cash flow, and that is going to be the initial amount you are going to start with. So every time you might be given a different amount depending on the balance that you are left with, because the initial one they give you is a starting amount, but it doesn't necessarily mean that you are going to spend all that amount at once. It can be a significant amount. They can give you, let's say, 10 million, but you might find that this 10 million, you might spend it for maybe 3 months, depending on those small petty expenses that you keep paying within the organization. So you'll find that the whole petty cashier is just managing the 10 million that was allocated to that small expense. So the initial amount of money that you are given is called a cash float. The cash float, let's just use a small amount. Let's just work in thousands. We say maybe you are going to be given 1,000 US dollars. And the purpose for this 1,000 US dollars is that you are being given that 1,000 US dollars for you to, this amount is going to be given to petty cashier. It is for you to cater for the petty cash expenses. So how do they know how much to give you as a cash float? It is always an estimate, just like the way we said, like, let's assume that our cash float to be 1,000 US dollars. So the management is going to assume, they are going to make an assumption, or they are going to estimate that maybe within a month we are going to buy, let's say we are going to buy pens, we are going to buy maybe stationery, we are going to buy maybe some sugar and other spices. So you find that these expenses are going to be estimated, that maybe within a month they are going to use, maybe they are going to buy some staple wires, they are maybe going to buy water for the office, they are going to buy reams of paper. So those small expenses that are going to be used within the organization. Now, depending on the size of the organization, you'll find yourself, you are going to buy these small things within a given period of time. And all these things, these small expenses that you are going to be incurring, you are going to buy to use to pick money from this small expense of 1,000 US dollars that they gave you. So your job as a petty cashier is to cater for that minimum amount that they have given to you, or that initial cash float, the initial amount that they have given to you to cater for these small expenses. And what you are going to do is that you are going to make an account for this 1,000 US dollars that they have given to you at the end of the period. So they give you that fixed amount, and then it will be you to keep on accounting for what you have, that I've spent such and such amount to buy pens, to buy rims, to buy sugar, to buy whichever amount. So for example, let's say that they have given to you that 1,000 US dollars, and that amount they gave it to you, it's supposed to be maybe for 1 month. And if at the end of the month, this 1,000 US dollars they gave to you, maybe you had spent 900 US dollars out of the 1,000. So it means that you are still left with 100. So you have spent 900 out of the 1,000 on the petty cash expenses, or on the petty expenses, or on those small expenses. Then it means that you will be left with that 100 in cash, and that will be the cash at hand. And when you are starting a new month, then you are supposed to be reimbursed. The word is reimbursement. Now, what this is going to happen is that for the first month, let's say this was Jan, they gave you 1,000 US dollars, and within that month you spent 900 US dollars. So it means at the end of January, on 31st Jan, you still have 100 US dollars. Now, what the organization is going to do, they are going to reimburse, they are going to give you back what you have spent. They are not giving you, in the new month, they are not giving you the whole 1,000 US dollars, but they are just reimbursing you the same amount that you have used in that month. So they are going to give you 900 US dollars, such that within, or at the start of the new month, you'll have a total of the same 1,000 US dollars. But this 1,000 is just the balance you left with from the previous month, plus the reimbursement of the amount that you spent. They give you the exact amount that you have spent. So the reimbursement, it means that you are going to be given only that amount that you have spent, and you are not going to be given the entire 1,000 US dollars. And because on the new month, the month for Feb, they will just give you this reimbursement, so that when you add the reimbursement, that is, they are giving you the amount that you have spent in that previous month, to when you add that to the amount, to the balance that is left on the previous month, you come back to the whole amount, which is the cash flow, the cash flow. They always give you it is always a reimbursement of the exact amount that you have spent in the month to make sure that you top up to the other. So there is no way you are going to exceed the 1,000, the cash flow that is given to you, because the moment you see you are going to exceed this, then you ask for the another amount. So if this month you have spent all the money and it all disappeared, then the next month they will give you just a reimbursement. It will be a reimbursement of the amount that you have spent. So they will give you back the 1,000 US dollars. So that's the reimbursement that we are talking about. So it is just they give you a reimbursement just to restore you to that same amount that it was given to you, or you are supposed to be with every month, meaning that in this case they will pay you only the 900, so that you add the balance of the previous month, which is 100, to make it the 1,000 that you are supposed to be with every month. So therefore this 900 will be the reimbursement, and this means that you are going to be given back the amount you spent from your cash flow, and you are going to be given it back to just to restore you back to the original position of the cash flow that you can just be able to begin with in the new period. And the system of going through this cycle where you are given a cash float, or where you are given a float and you spend it, and again they reimburse you back to that cash float value, that process, it keeps on continuing. And that system is what we call the interest system. So the interest system is the process where they keep on reimbursing you the same amount that you've been using for that month. So the interest system is a system that is used to create Petty Cashbook, whereby the petty cashier is given a float, and then is going to be reimbursed at the end of the period, depending on the type of the organization and their policies, because at the end of every period they can define for you and they give you a reimbursement, so that you can come back to the value of your original float, and then you start the new period with it. And that's the concept of the interest system. However, one thing that you should also understand is that it should also be possible that if, for example, the defined period is a month, then it is possible that before the month ends, you might exhaust the whole amount. And when that happens, it's also allowed for you to go for the reimbursement within the same month back to the original float, because they may tell you that you are going to spend this 1,000 US dollars, and you find that this 1,000 is finished within the month of January. So it will be the same thing. If it is finished before the month ends, you also go back for a reimbursement of the same 1,000 US dollars within the month to restore you back to the same position of the original cash float. So that's what you should also understand. So that reimbursement for within the same month will take you back to the original cash float, and it is necessary that you have to wait for it to get done. It's always necessary for you to wait for that cash flow to get done, but you may also have to exhaust you have seen maybe that if you had reached 900 and you see maybe the next expense is going to take you back to maybe 100 and 1,000 and 100, then you can ask for the amount, because you might see maybe by the time you have reached 900, the next expense is, let's say, 200, but you're only left with 100. You also go back for the same reimbursement, so that you can be able to cater for the other amount, the other expense. I want to repeat one thing, and I want to say that you need to understand that it is very possible that if, for example, the defined period is, let's say, it's a month, just like the way we said that it's a month of Jan, and it is possible that before this month ends, you may find yourself that you have exhausted the whole amount. If, let's say, as I told you, that they had given us an amount of a cash float of 1,000 US dollars, it may happen that before the end of this month, you have exhausted the entire 1,000 US dollars. And when that happens, then it's allowed for you to go for a reimbursement. It will be allowed for you to go for a reimbursement within that same period. I'm repeating this because I know this is where the question will come from. So you'll be allowed to go for a reimbursement within the same month, so that you can be reimbursed that amount that you have spent to go back to the cash float of 1,000 US dollars. That is the original float. And it's not necessary that you'll have to wait for this month to end, or even this amount to be consumed, all of it, because it is very possible that you may have maybe used, let's say, 900 US dollars, and you find that maybe your next transaction, next transaction is, let's say, 200 US dollars. You are seeing, if you deduct this is 1,000, that is the initial they gave to you. If you deduct this 900 you have so far spent, you will see that you'll have a balance of 100. That is 100 US dollars. But you will see that your next transaction is up to 200 US dollars, meaning that amount is not there. The extra 100 is not there, because what is left here is only 100. What do you do in that kind of a scenario? So you are seeing that in the next transaction, you are supposed to income more than what? More than the remaining amount that you have in that same amount, or in that same period of January. So what you do, of course, this petty cashier has to go to the main cashier. The main cashier now, that will be the person who is giving you the money and is the one that is handling the main cash book. Remember, this amount will be reflected in the main cashier's records. So in this main cashier, it will be looking like as if it is a payment, but in the petty cash, it will come as an income, and it will be on the debit side. So the petty cashier will have to go to the main cashier to request for a reimbursement. Of course, the main cashier will only give you this 900, because this is the money that you have so far spent. Because every time you go for money, it will be just a reimbursement, just to top up to the position. So the main cashier will give you 900, and this 900 US dollars, if you add the 100 that you have, it will take you back to the 1,000 US dollars. That is the threshold you are supposed to be with. And that's where you will pay off this extra 200. So the main cashier will just give you the reimbursement, just to take you back to the main, to the original float that you are supposed to be with. And it will be from that original float that's where you will start spending again. Therefore, all the time the reimbursement, all the time when the reimbursement is done, it must be to bring you back to the original float. And that's what we are trying to say. And we will not say that since you are coming back, maybe you are coming before the month ends, then you are going to be given the difference. Because it is very possible someone might look at it in a sense that, since this person, because now this next transaction is still within the month, maybe it is the extra transaction that is remaining for the close of month to come. And you are seeing that this amount, you have already spent 900, but you are seeing yourself the next transaction is 200. Someone may say that, why don't the main cashier just give you the 100, because it is the balance to offset this. Then you close off that month, 31st Jan. Then in Feb, the main cashier gives you the total amount. That's wrong. And the reason as why it's wrong, it's because if the main cashier gives you this, and in the next month he gives you this 900, this, if you add the entire amount, this one will have exceeded the original threshold. It will be 1,100 US dollars. That will be higher than the original threshold. Even if you say that maybe, since here you have exhausted the 900, this one, you have exhausted the 1,000, and maybe the cashier should in the next month should give you less because in the first month you exhausted. This one you exhausted and you went up to 1,100. So the other one could think that maybe in the month of Feb, the main cashier should give the petty cashier 900. So that when you add this plus this, it gives you 2,000 US dollars, which is for the 2 months. That's wrong also, because every time the petty cashier goes for a reimbursement, that reimbursement should be for the expenses that have been paid, or that for you're just paying back the money that the petty cashier has spent, just to restore that petty cashier back to the original float. You need to take care of that, because if you don't, you'll find it in the question. Maybe we shall understand more when we look at the practical question, but that's basically what we are going to be doing. So the reimbursement is supposed to be bringing you back to the original float. And that's what this is all about, the interest system. So anytime the petty cashier comes for reimbursement, you will be given the total amount you have spent so far, and then you will be restored back to the original float. And that's basically the interest system. However, let me also tell you something, that in most of our organizations today, especially in Africa, now, what we have in Africa, or what we have done, is that we try to combine the petty cash. We try to combine the petty cash with the main cash book and the main cash book. That's basically what we try to do in Africa. We try to combine the petty cash and then the main cash book. So what that means is that we combine the petty cash system with the main cash book system. Because if you try to look at some of the examples, of course, we have the government institutions. The government institutions, that's what they do. They combine the petty cash systems with the main cash book systems. So you find that their cash book system is the same as their petty cash system. So you find that these companies, you find them making all the petty cash and then the main cash expenses in the cash book. Everything appears, all the petty expenses and then the main expenses are appearing in one cash book, but they try to use what we call the analytical column. They try to use what we call the analytical column. As they combine the petty expenses and then the main expenses, they try to use what we call the analytical column to try where they are going to share, and they try to put the details of those expenses that they have incurred, just like categorizing the different expenses. And I will try to show you how that is done when I go to the format, because it's also a situation where you find that you get interests for the petty expenses as well as signing the main expenses for the cash, or the major expenses of cash. So some organizations try to combine, and then they spread the analytical column, but the right way to be done is to maintain a cash book for your major expense, and then you are also going to maintain a petty cash book for your minor expenses. That is the best way to do the things. You separate the petty cash and then the main cash, you separate. That's the best way, but most of the things that we do in Africa, we just combine and we spread the analytical column. But we shall have a look at that maybe when we come to the format. But the best option is for us to have the Petty Cashbook and then the major cash book for both our minor and major expenses respectively. Because if you do that, you'll be given a float and then you'll be doing it by the interest system, and that's basically what the interest system is all about. You'll be given the reimbursement for the expenses you have incurred, just to restore you back to the position where you were at the original float. So what I'm going to do now is I'm going to give you the format of a Petty Cashbook, and then we will use it to take a practical question, because I believe that some of these topics we understand them by solving a practical question. However, before I give you the format or the layout of the Petty Cashbook, let me also make you understand that the Petty Cashbook also follows the double entry system. You have to understand that it also follows the double entry system. The Petty Cashbook follows a double entry system where it has the debit side, and it also has the credit side. On the debit side, of course, this debit side will always have the receipts of cash. It will always have the receipts of cash, and then the credit side. And of course, most of the times the receipts of cash in the debit side is always the cash float or the float. It is always the cash float that will be always in the debit side of the cash book, because there we shall have either the cash float or we shall be having these reimbursements. So it is either an initial cash float or reimbursements of the amount that we have spent, and that's what is going to be under the debit side. And then the credit side of the Petty Cashbook is for payment. There is a column for total payments, and over here the payments are split into analytical columns, meaning we are trying to group the expenses under different headings depending on the category of an expense that we have incurred. So in this, because we are going to have the debit side is going to have the what we call the payment side, the payment, but this one, the payment will always be in two different analytical columns, and these analytical columns will be showing the categories of expenses that we have. For example, we can have a column for postage, we can have a column for travel and transport expenses. So all the expenses that are related to transport will be within that category. We can have things to do with wages and salaries. That would be an analytical column. We can have a column for utilities. So that's how the analytical column, that the utility column will have all the utility bills. So what we are trying to say is that every payment that we make from the float we will have to record it facing the total payment column, and then we extend it to an analytical column to show that this payment is under this kind of category, so that at the end of the period, even though we are going to be getting the total payments for every category that we have, or that for every payment that we have made, then we are also supposed to get the total payments for every category of expenses, because we are going to find that we need to understand how much did we spend on transport and travel. Meaning for us, having known that the total payments were, let's say 10 million. But out of the 10 million, maybe we have a category of travel and transport. We spent maybe 2 million. Under postage, maybe we spent 1 million. Under salaries, maybe we spent 6 million or 8. Under utilities, we spent maybe 2. So that's how we are going to be getting. That's the reason as why we get these analytical columns. These analytical columns will just show the different categories. But all those analytical columns, they are going to be showing, or they are going to be under the payment. So these analytical columns are just sub payments that we've made, or subcategories that we've made under payments. So there are times even when we have also creditors within the analytical columns, because some creditors can be paid by using the petty cash book, especially when the creditors, they are demanding us very little amount of money and not a very huge amount of money. Because if the creditor is demanding us a very huge amount of money, then it means that creditor will be paid out of the major or the main cash book. So we might not have that appearing under the petty cash book. But if the creditor maybe is demanding us something very small, maybe the creditor has supplied us maybe some pens, 1 box of pen, we can pay that one out of the petty cash payment, because the amount is small. But if we have maybe a creditor that supplied us maybe billions and billions of shillings within maybe raw materials that we use in the manufacturing, then that is supposed to be paid out of the main cash book. So we can at some point we can pay off the creditors using our petty cash book, but there could be another column. It could be a column or a ledger, but you just know when you put in the creditor or that creditors where you have paid them, it will also be under the total payment. It will be under the total payment column, and we are also just creating that as a different analytical column. We create an analytical column to show the creditors, but that should also be under the total payments column. However, the funny thing about this petty cash book is that, you know, when we talk about the cash book and then the double entry system, the debit side has its column for particulars, debts, particulars and debts for recording, and the credit side too will have its particulars and then the debts. But when it comes to the petty cash book, because that's mainly what is done under the double entry system, that you have the debit side. Under the debit side, you have your particulars column and the debt, maybe even the folio. It's looking like as if it is just a T account, where you have the particulars and then you have maybe the debt, the particulars, then the folio, and then the amount. And the same happens. This is the debit side, this is the credit side. But when it comes to the petty cash book, then it's different, because there is only one column for particulars and it is in the middle. And then we have only one column for the debt. So these particulars and then the debt column will cater for both the debit side, and at the same time it will cater for the credit side. So let's look at how interesting the petty cash book is. So we look at the structure or the layout. We've said we have the receipts, we have the folio, we have the debt. I told the debts and then the particulars column, they are in the middle. Then we have the particulars. We can have what we call the voucher numbers. We can have vouchers. We have total payment. And now when you're done with the total payments, then you will split the analytical columns, where you can have maybe wages, They can be wages and salaries. We can have very many. So this one, they are still going. We can have wages. You can make each one of these as a column. Let me change the color. You can make a column for wages. You can make a column for traveling. You can make a column for postage. These are supposed to be added this side. You can also make a column for cleaning. You can also make a column for creditors. You can add as many as you want. All these are supposed to be represented by column, a column. They're supposed to be this side. You put all of them there. So we have the receipts column, and this receipts column for the debit side, and then we have the column for ledger folio. This is a column for ledger folio, and I told you that the ledger folio is more of a reference. And then we have a column for the debt. That's where we put the debts. And then we have a column for particulars. And that would be the debit side of the cash book, of this Petty Cashbook. Now we have another column for this is vouchers. If you don't call it vouchers, you can put maybe voucher numbers. And also have a column for total payments. And finally, we have, these are the analytical columns starting from here. All these are supposed to be columns. Those are the ones that we call the analytical columns that we'll be following. So we can add maybe 4 extra analytical columns depending on the question that you are going to do. If let's say it has 4, the 4 analytical column, of course, this first one, the one for wages, then the traveling, the postage, and then the cleaning. This one, the creditors column, is not an analytical column, but it's a little bit different because it will not be analyzing. It will be just paying off some creditors with small payments. So because that we have indicated that we have shown maybe 4 analytical column, then another column for the ledger folio, and the last one will be for creditors. Because you see under creditors, this column here, we might also have a small ledger column or ledger folio, but that one I will explain a little bit maybe later. But just know this, you add extra analytical columns, then if they are because now sometimes the creditors may not be there. If they are there, the ones with the small payments, then we can also show that creditors column. But just know we have these columns, these ones, and this one, then we add other analytical columns. So let's look at the debit side with the receipts. Of course, now the debit side, we always put in the amount that is going to be given to us as let's say the cash float. That is the initial float that we have. The receipts, of course, the receipts here we put the currency. If they are going to be in US dollars, Ugandan shillings, depending on the currency that you are working with. So the first column, that would be the receipts side or the receipts column, and then we have the ledger folio with another column for date, and then the particulars, or what you can call the details. If you don't call it particulars, you can call it details as well. But when you're looking at the Petty Cashbook, the debit side is this left hand with receipts folio. This will be now the debit side. This one, the left hand side. Basically, that will be the debit side. Then the credit side, of course, will be this side, which has the payment side, of course, will be the debit side. The credit side of the Petty Cash will be now the payment. This is now the payment side. The payment side, of course, we start with the voucher, this voucher number, and then we also include in the total payments, these two columns. This one, within these two lines, these are the payment, the payment side, or what we call the credit side. I told you this data and particulars, they are always in between. So the credit side of the petty cash is just the voucher number and then the total payment. That is the credit side of the petty cash book. Now, these particulars column, the particulars column and then the dates column, these are the ones that are in the middle. As I told you, that is the difference that we use. We have only the date and then the particulars once, even though it's a double entry system. So this means that when you are recording on the debit side, then you will use the same particulars and then the dates column. And also when you are recording on the credit side, then you will also use the same particulars and then the date columns. And that's the interesting fact about the petty cash book. However, the whole petty cash book ends at the total payment. What you have to understand is that the whole cash book ends here. The petty cash book moves from this to this point up to the total payment. This analytical column is not always there. The petty cash book ends at the total payment column, such that these voucher numbers and then the total payments column will represent the credit side, while the receipts and then the ledger folio on the left hand side columns will be representing the debit side of the petty cash book. But the date and the particulars columns are in the middle, where they cater for both debit and the credit side of the cash book. So this is where we have the petty cash book has this receipts folio. That is the debit side. Then we have the credit side, we have the voucher numbers and then the payments. Because when you're paying, you pay through the voucher numbers, payment vouchers. Then what is in the middle here will be the date, and this date and then the particulars column will be representing or will be catering for both payments and the receipts. But when we come to the credit side, because I have told you that total payment, this total payment column here will be recorded, this total payment will be recorded, but we will need also to extend the payments under their various headings or categories. And we will be having a lot of categories or headings when we are going to create the category totals for each, because these total payments, as I told you, as I write the total payments, we need to know that these payments we have incurred, we can say maybe under transport costs, we have incurred maybe 10 million. But the question is, how much did we spend on business-related transport costs? Because within the transport cost, we may have costs that were included, but they were not maybe generating income for the business. So that's why we need to have those different categories to highlight the category totals that under transport we summed up such and such amounts to be able to total up that total amount that we have shown under the payments column. However, I also want to explain something to you, that most of the questions may decide to give you the headings, the category headings that are belonging to the different analytical columns, or what we call the category columns. And then the examiner might tell you that you group such expenses in such headings or such categories. But if maybe the examiner has not given you these categories, then the examiner will expect you to use or form your own categories or headings, so that you can look at your headings of expenses, and then you create your own headings depending on the different expenses that they have given to you. Although in most cases, and let's say, now let us look at the next payment, which is on the 3rd. That is traveling expense of $150. So on 3rd, there was a traveling expense. Let's say it is voucher number 002, which is 150. But this traveling expense is different from wages. So we cannot put the traveling expenses under wages. So you'll have to create another column for traveling expense. So you're seeing this one is a traveling expense. That is a traveling expense column as one of the second analytical column. Because it is the traveling is different from the wages, we can't put it in this column, the first column for wages, the first analytical column that we created. So what we are going to do, this transaction happened on 3rd. We record it under date. In particular, as we put traveling expenses, we assume that it is payment voucher number 002. That is what we included here. Then the total payment that we paid is $150. But this same $150 has to appear in the same traveling expense column under the analytics columns. So we put it there. Then these other columns we put nothing. Remember, we create this analytical column on a step by step. So these ones are not yet drawn. So we started with this one. Now we are now on this one, the one for traveling expenses. So we are done with that. So under the analytical columns, we are now having the wages as the extended to wage column. We have traveling expense, which will be extended to the traveling column. And basically, that's how we go about this analytical Petty Cashbook. The next one, or the next transaction, is on 4th. The next transaction, so it is on 4th. So we record under the date column, we record 4th. What is the transaction? It is called postage. So we write under particulars, it's a postage. We can call it payment voucher number 3 under the payment voucher column. How much did we pay? We paid $100. We included it under the total payment. That is the total amount that we paid. But that is under a new category for postage, because we can't put that 100 under wages or traveling columns. We have to create another column called postage. So once that is done, we include that same amount in the same line or on the same date. So we have recorded that total amount as $100, which we can call voucher number 3. Now we can see that the postage cannot be under the wages or traveling expenses as the category. So we created another category for postage. And that's where we put the same $100 in the postage column in the same line. So as long as you have different category of expense that you have paid, then you have to create a different column so that it can be extended. And that's the meaning of the Petty Cashbook. It's only the easiest, it is actually one of the easiest topics in accounting. So you should just pay attention and we'll be able to sort it out. So as long as the expense is different, you go ahead and create another analytical column. Now, the next transaction is on 5th, and that is traveling expense. We have also had a traveling expense. So this is the traveling cost, the traveling expense. Remember, these transactions, we are recording them first hand. So what we do, since we already have traveling expenses, we record it on 5th that we incurred the traveling expense. and we create a different payment voucher, because these ones, once the date has passed, it means those transactions are now done. The moment you have anything new to pay, even if it is the same payment, if let's say you are paying wages, casual workers have come to work today, the same casual workers will come to work tomorrow. It is the same thing. The voucher number that you have when they have worked today, it will be a different voucher number when they come to work tomorrow. That's why even here you are seeing that we have this as payment voucher 004, and the amount is 100,000. Now, since this is a traveling expense, under the analytics column, we don't create another column because we already have a traveling expense column as a category. So what we just do, we just create that amount in there. So the implication is that when you are at the end of the day, you will be adding up that I paid $150 on third, and I've now paid $100 on fifth. That means I've so far paid $250 as traveling expense for the 2 days. So at the end of the month, someone is going to ask you, how much have you incurred on traveling expenses? So you will just add up the traveling column. I hope now we are seeing the reason as why we have these columns. This same amount will reflect in the totals, but these columns will give you an analysis of the different category expenditures that you have incurred. So you've seen that. So as long as it's not a different account, we don't create an analytical column. That's what you need to understand. So we are done with that happened on 4th. The traveling expense. So the traveling expense of 100, we still brought it under the traveling expense column, so that at the end of the period, we add up every column to know the total expenditure that we have made under each and every category before we can look at the total payment, the overall payment that we have paid in that month. Now, that's how we are going to be repeating these transactions. So your exercise is do the rest of this, because my main emphasis is to show you what happens after you have put in all the entries. So that's basically what we are going to look at, what happens after you have put all the entries there. So we just want to look at when we are adding up the things. We want to look at the end of the period. How do we balance off? You can see how the things were done. So my emphasis is at this bottom side where we are closing off the account. Now, once you are done with the transactions for the payments and you have recorded each and every item that was there, what you have to do is now looking at the reimbursement of the costs that we incurred as at 31st August 2018, because that was the year they gave us in the question. Now, to do this, we are supposed to balance off these accounts, because when you have posted all the entries, you need to balance off. But balancing off is more of trying to know how much the cashier should be reimbursing the petty cashier. So you need to be very careful when we are balancing off this, so that you can be able to know what exactly is done, especially for reimbursements. Now, we are going to find the totals of both the debit side and then the credit side. And when it comes to balancing off, then I want you to first look at both the debit side and then the credit before you think about these other analytical columns, because there is no balance brought down and carried down within the analytical columns. For them, they are just totals only. We just put the totals only. The balance brought down or the balance carried down is only within the debits and the credit. I told you that the credit has the payment voucher numbers and then the total payment. Then the left-hand side is where there is the debit side, where we have the receipts and then the folio, ledger folio. So now let's balance off. So what we need is to balance off the debit side and then the credit side. And when we add up all these total expenses or the total expenditures in the total payment column, this column, when you add all these that are here in that we've incurred for all the different days in the month of August, you can see that it's giving us a total of 3060, meaning it is 3060 US dollars. That is the total that we spent, the total payment within that month. But now we were given 4,000 US dollars, meaning you get the 4,000, you less off this. What do we have as the balance? So we are given, the cashier gave us 4,000 US dollars and we spent 3,060 US dollars, and this means that we only need a reimbursement. This is the reimbursement that we need, the reimbursement, because they told us they always reimburse what we have spent in the month. So once they give us this back, we shall be able to go back to the total float of 4,000 US dollars. So the best thing to do here is to make the 4,000 US dollars the total for both sides. So you are seeing this one is 4,000 US dollars. So we make the 4,000 to be the balance, the total for both sides. And now the balance carried down. The balance carried down will appear on the side that has the smallest amount. We balance it as usual. So when you get the 4,000, now, as I told you, you need to make this 4,000 the total. Once you make this 4,000 the total for both sides, it means this side, the balance carried down will be on the payment side, because the payment side has 3060, but this receipt side has 4,000. So there is that difference. Now you will find that the balance brought down will actually be on the credit side of the Petty Cashbook. So the balance brought down will be on the opposite side, meaning the balance brought down will be on this side, the receipt side or the debit side of the Petty Cashbook. And when these reimbursements of the 60,000, this one, when this reimbursement comes and it is given to the Petty cashier, they will add this reimbursement plus the balance to make sure that we go back to the total float of 4,000 US dollars, and that will equate the full cash float that we started spending, because that's the money that we shall be having for the next month, that is September 1st. That's the money that we will be having for spending. However, our question was specific, that they wanted us to take the reimbursement before the period ends. You need to be very careful here. What I have just explained, that's what you would have done if the reimbursement was supposed to be if the reimbursement was supposed to be paid maybe after the period. But remember, the reimbursement was before the period ended. It was on the same date, on 31st. That's when the reimbursement was made. So how do we handle that? Because they told us we shall take the reimbursement on the 31st. The same day that we are closing off our account is the same day we are taking the reimbursement. So we are not taking the reimbursement on 1st September. We are taking it before the period ends. So the implication of us taking it before the period ends is that by the time we go on September 1st, we have the whole amount with us. Therefore, on the 31st, we shall record cash of 3060. This is what we are going to do. Oh, that's how, this is what the examiner wanted us to do this. The implication here was, the question told us that the money was picked on 31st. The reimbursement was done on 31st. So it means on 31st, we are recording cash. That is the cash you are seeing here on 31st. And this cash is coming as a debit. It's under the receipts because we are receiving what we spent. And since we are receiving what we spent before the period ends, then we need to close off the accounts. So the 3060 is supposed to be on the debit side of the Petty Cashbook under the receipts column to show a reimbursement of the exact cost that we have spent. And then we can finally balance it off as usual. So now we balance off as usual. How do we balance off? So the balance carried down will be now the 4,000. Why? Why are we going to have the 4,000 as the balance carried down? It is basically the balance because we had this. We were given 4,000 at the start of the period and we were reimbursed 3060. This is what we have. This is what we have here and the first one that we had up here. So once you add this, it is 7060. But remember, we have so far spent 3060. So it will be the 7060 minus the 3060. And that will give you a 4,000. So it means at the start of September 1st, we shall have 4,000, which is the same cash float that we are supposed to be with. I hope you are getting what I'm saying. The balance carried down will be 4,000 because here we have received the reimbursement. So this one increased. This one increased. This is what we have so far spent. So it means if they have reimbursed us this amount on 31st, it means the total amount that we have is 7060. That is going to be the total for both the sides, 7060. So the balance carried down, because this side is smaller, this side, once we added all this, was giving us 3060. So we get 3060 minus the 760. We remain with 4,000. That will be the balance carried down on the credit side because the credit side is smaller than the debit side. So here we shall have the balance brought down, but this balance brought down will be this side you're seeing on the debit side. That's why you're seeing this amount here, 4,000, and it is on the date of September 1st because that is the money that we have at the beginning of the next month. That's the money we shall start with at the start of September. So the debit side was having 7060, which will be the total for both sides. And then the balance carried down will be, the balance carried down will be 4,000. And that's the same amount that will be on the balance brought down as of 1st September. And that's basically how we do the balancing off if the question says that we received the reimbursement before the period. And finally, for analytics columns, we just have to add up the total for all these columns, and then you show their totals for each and every column. So what we need to look at in the part 2 or in the lecture number 2 of this same video on this same lecture on Petty Cashbook, we need to look at something that is not a little bit straightforward, because this one was a little bit straightforward, but we need to look at expenses when maybe we have incurred an amount and we have exceeded the cash throat within the period.